right, welcome to Peace of Mind Radio. I am Brian Ramsey along with Eric Douglas and Isaac LaFawn. What's up, fellas?
What's going on, guys?
Hello, hello, hello.
All right, so today is actually a follow-up from last week's episode where we talked about asset titling and the importance of asset titling, and kind of we delved in a little bit about probate. We talked a little bit about trust planning, which is, as these guys know, is something I kind of go off on.
Nerd alert.
Nerd alert. There you go. But if you didn't get a chance to catch that show, make sure you go back to our YouTube page or our channel with the
Our podcast
channel. Thank you. Go back and catch those. And we do these every week. So if you like the content, just make sure you subscribe to our channels, and you'll make sure you'll be updated when we send out new one. But I think we send them out every Wednesday. It's kind of our thing now. So we'll produce new content every Wednesday. All right. So what we're talking about today, because this is something that Isaac brought up at the end of our show last week. We were talking about just the importance of asset titling, and we kind of reviewed a lot of different assets. But the one that we mentioned was what we call a non-retirement account. It's also referred to as a non-qualified account. We'll tell you what all that means, or traditional brokerage account.
Yeah.
And what we want to do is talk about sort of the importance of that account. Now, and the reason we did that is I think we mentioned in the last show that when we kind of breezed over like, hey, this topic really needs to be discussed in a lot more detail. So we thought we'd make it its own show because there is a lot of, would you say, misunderstanding? Misuse?
It's not. It's kind of like trust planning. You know, people think it's only for certain families of certain net worth or whatever. And they don't realize that it's not actually that costly to appropriately title and do things. And non-qualified investing is very similar. People think about there's a lot of conversation in the media about Roth IRAs and traditional IRAs and 401ks and all this stuff, but not really talking about how you use non-retirement accounts to build wealth and transfer wealth.
Yeah, that's right. Yeah. So, and there's just a lot we're going to unpack in this episode, and we're only really talking about one account type, which is kind of strange. And we also we will do a show at some point down the road talking about different account types, because one of the things about the non-retirement account is it can be tax efficient, but it can also be very tax inefficient. And we will go through each of the account types and talk about the tax efficiency of each of them. And the reason why we want to talk about the non-qualified account or the non-retirement account, and we'll talk about the taxation of it in a few minutes, is because you have to understand how this account is treated today and how it's treated 10, 15, 20, 30 years down the road. That's what Isaac's referring to. So that being said, let's talk about when we talk about non-retirement accounts, non-qualified accounts, what do we mean by when we say non-qualified account? We have qualified accounts, right? And then we get this one non-qualified account.
Well, I think if you're going to talk about what a non-qualified account is, we probably want to start by explaining what a qualified account is. And qualified accounts, and you mentioned them already, those are your workplace retirement plans. Those are going to be your 401ks, your 403bs, 405(9) plans that you're going to get just basically through work, as well as your also traditional and or your Roth IRAs. Basically, what all of those plans have in common is that you contribute a certain amount of money per year. There's usually going to be a limit on the amount of money that you can contribute based upon the specific plan. So you're going to have different contribution limits in a 401k versus a Roth IRA, for example. But the benefit is always going to be you're going to grow those assets, or those assets grow tax deferred. So you're not having to pay taxes on the gains every single year that you accumulate them. So if you have a gain in a year, that gain is not going to be taxable in any given year. Now, obviously, the trade-off for that is going to be when you do take out those gains, usually in retirement, of course, that's what they're earmarked for. These are retirement plans. They're designed to encourage saving for your retirement, but you're going to have a different type of a tax treatment. So you're going to have basically, if it's coming from a qualified plan, it's usually going to be completely earned income, treated as earned income versus like a long-term or a short-term capital gain. Yeah. With the exception, of course, of a Roth IRA, those are going to be treated as tax-free, post-tax, if you will.
Yeah. And qualified for the IRS is basically means rules.
Yes.
Yeah, that's right.
It means rules. And so the beauty of non-qualified or non-retirement accounts is it doesn't have the retirement rules attached to it. They're more flexible. Their contribution limits don't exist. Like, there are some rules. I won't say there's no rules, but it's not like all these age banded rules and all this kind of stuff. So
you don't have to concern yourself with knowing what your employer plan will dictate or what they will mandate. You don't have to worry about how much you can contribute in any given year.
What can I invest in?
If you have to worry about tax liabilities, if you take money out before 59 and a half and things, all those arbitrary mandates, all those handcuffs, you don't have to worry about those with non-qualified or non-retirement accounts.
Yeah, so the other interesting thing about, and we're going to jump into this now, is that all the accounts you guys are talking about, when we talk about asset titling, is pretty much just you, right? You can be the only owner of all those accounts you guys just mentioned.
Correct.
You can't have a joint Roth or a joint IRA or a joint 401k. You can't do that. The non-retirement account, I'm gonna refer to it as a non-retirement account, but just know it's also a non-qualified or traditional brokerage account. So the non-retirement account, you can actually own it either individually or in joint title, right?
Or as a business.
Or in an LLC? That's correct. Yeah.
Mm-hmm.
But let's talk about one of the most common things, and we all know we can own a brokerage account individually. That's without saying. Now, and we mentioned that a little bit last week about how you would want to own that if you own it individually by putting a TOD on there. So if you didn't catch it, make sure you go back and listen last week. But we're talking about joint ownership, typically with a husband and wife. Not always the case, right? Because I actually have an account with my dad. We own it jointly because we own a specific asset that's inside that account. But when you own it with a spouse or with anybody else, and it's funny, right before the show, I had listed all these different ways to own. And honestly, there are two of them in here I hardly have ever seen in all my years of doing this work. But Isaac comes in, he's like, dude, I've never heard of this one. I go, well, the only reason why I put it on there is because when I Googled it, it popped up. I totally forgot it was a way you could own an account.
Oh, yeah. All I knew was that I wouldn't use it. I was like, I have read this at some point. I realized it has no benefit, but I was like, just maybe you see something.
Yeah.
I'm just giving you full heads up. Don't ask me about it.
Okay, so listen, when you take your CFP exam and you get tendencies by entirety and you get that question right, you're going to say, Brian did a show on that.
Yep.
All right, so
the CFP board will be super happy that I know the answer to that question.
Right. Yeah, one out of the 750 you got to do. All right, so the most common that we talk about is joint tenants of rights of survivorship, right? So when you have an account, and let's just kind of quickly talk about that. You own an account, let's say with a spouse or with a significant other, and you own it, joint tenants of rights of survivorship. What does that mean?
Oh, basically the two of you own the asset equally.
That's right.
That's it. There's really no bells or whistles to it. The two of you both have the exact same amount of ownership to that property as the other.
Yep. And so one spouse passes away, what happens?
It's automatically transferred to the surviving spouse or surviving owner, whoever that may be.
Yeah.
Whether it's most commonly used in a husband-wife situation, but in other situations like you just mentioned, it could be transferred to whoever the surviving owner is.
Yep. Okay. Now, here's the other kick to that is, and this again goes back to the show we talked about last week. So if you didn't catch it, go back and watch it. If you have a joint rights of survivorship, and let's just say, most commonly we have a husband and wife, they both pass away in a car accident or in the same accident, what's the issue with that asset? It's a probate asset, right? At that point.
Yeah, so it's going to go that this is why you always, going back to trust, right? This is why we always focus on or encourage clients to use trust, because if there's not a contingent beneficiary on there, it will go to through probate.
Yeah. And you can, we encourage every client to do this because, Isaac's going to go through a great scenario here in a little bit. So make sure you keep listening, but we're going to talk about how assets, particularly low basis assets, how they should be titled. But in the event that you just have a traditional joint account, you can put a TOD, which is a transfer on death provision on that account, or sometimes it's referred to as a POD, depending on the institution, which is payable on death. But you can then add a TOD or a POD onto that account. You are not, I get this question all the time. Well, if I put my kids on there, do they have access to my account? No, that's not how POD or TOD works. You're essentially just naming a beneficiary to that particular account. So even though if it's joint, the likelihood of both spouses or both owners passing away at the same time is very low. you still, from a risk perspective, you want to make sure you have your assets titled properly. And when you have a joint account, you want to make sure you put a TOD or a POD provision on that account. And by the way, if you don't understand what we're talking about and you got questions, give us a call. We'll walk you right through it. Second one. Do you want to do this one? No. Okay.
Dude,
all right.
I appreciate you asking me though.
No. So the second way you can own, and I will tell you, I rarely have ever seen this. Although I'll give you a perfect example in just a second. But it's called tenants in common. Tenants in common basically is you own it equally, but in the event that somebody passes away, or you want, you want to sell your share, that owner has the right to sell that share without the other owner being able to stop that person. So we see this a lot in multiple owners of a piece of property, let's say like a rental piece of property, for example.
Yeah.
Now, is that the right way to do it? No, but we see it. And so we have to educate all the owners when they come to us and go, hey, I own this piece of property. Well, how do you own it? Well, I own it with 4 other families. How do you own it? Well, I own it individually. Okay, wrong answer.
Yeah.
And
that's why my knowledge is nope.
Yeah, because we don't really know that much about it.
We're not putting any of that stuff in place.
Because as soon as we see it, we own it tenants in common. Okay, you're going to change that because that's not how you do it.
Yeah.
And if you want to know how you should do it, listen to last week's show or call us and we'll tell you.
Yeah.
And the number's right up here on the screen. So tenants in common, again, that's just equal ownership, but you have the ability to sell your other your portion of it, or if you were to pass away, unlike joint rights of survivorship, the other half doesn't automatically go to the other owner. It's actually into their estate. So that can get very monkeyed up, especially when you have an owner, let's say 3 owners or something in a piece of property, and one of them dies. That can get very ugly because then you have to go through probate, and you can't do anything with the piece of property until the probate's settled and get kind of messy.
Where you see it a lot more is where you used to see it a lot more is with like siblings. You know, if somebody's going to pass an inheritance down to the siblings and they're going to own a joint account, joint tenants in common, and maybe a third, and a third between 3 siblings. And if one of those siblings were to pass away, then the ownership of their third of the asset is going to be passed down to their children, for example. And so now you have the 2 siblings that own their portion in conjunction with perhaps a niece or a nephew. That's probably the easiest way to think about it.
Yeah. But again, just if you're listening and you're going, tenants in common, I own something tenant in common, don't do it that way. Just form an LLC, own the LLC. It's so much easier. All right. So the other way you can own, which is now Isaac's favorite, is
there's so many advantages to it. I can see why.
I know.
I should be more up to speed on how amazing this one is.
It's called tenants by the entirety, and just I've never in almost 20 years have I ever run into this. Actually, when you fill out our application, that's not even an option.
Yeah,
tenants by the entirety.
These two, I think, based on how it used to have been done, I think it more like legacy. It's stuff that they have to leave in place, and we have to be knowledgeable on it when we run across it. We certainly need to look it up, but it's like
that's what Google's for.
I know. That's
just
why,
Google it.
Yeah, the testing requires that we know the answers when we take the test, though.
Yeah, but that's again something that we don't ever run into. But I thought it was curious when I was doing my research for the show. I thought, well, hey, it's something on there, and we can, if nothing else, makes us look smart. Well, I don't know. Maybe it doesn't because we're like we don't even never.
Maybe not in this case.
Maybe not in this case. All right, so we're so real quickly, let's just go back and review. This is a little bit of last week's show, but I want to talk about probate again because this is really one of the reasons why we talk about asset titling. One, it's for a risk factor, which we'll talk about here in a few minutes. But secondly, it's mostly because we're trying to either avoid probate altogether, which is a probate avoidance tactic, or we're trying to minimize the impact of probate, or minimize the amount of assets that have to run through probate. Again, probate's not awful. I've done it several times for clients over the years. It's just really a pain in the butt.
Fees,
and if you do
fees,
there's fees involved.
Time and fees.
Yep. But literally, if you have a good estate plan and you do the proper asset titling, you can avoid probate altogether. Right now, there's some argument that has been that's out there and still is, that you don't necessarily want to totally avoid probate altogether, because you're not giving creditors that 6-month window they have to come back at your estate. So they sometimes will say leave a car in your individual name so that you can quickly probate that. That opens up. I'm going down a rabbit hole, but anyway, just if you want to know
30 more minutes.
If you want to know what we're talking about, just call us. We'll explain why you leave a car in your individual name. Anyway, let's talk about probate. So joint rights or survivorship. We kind of, either one of you guys want to hash over that again? Just when you own an account, joint rights or survivorship, what happens?
Well, it just goes through probate. So just like any other asset that doesn't have a beneficiary on it or a transfer of death.
Upon the
death of the second owner,
yeah.
yes. So if you have joint tenants, obviously joint owners, once both owners pass away, there needs to be either a TOD designation or some type of beneficiary on there. If there is not, then it will go through probate.
Yeah, but there's no probate upon the passing of the primary, of one,
That
right?
is correct,
So
yes.
it's only at the second.
The ownership automatically transfers 100% to the surviving owner.
Yep. All right, tenants in common. As we mentioned a minute ago, that is one where if there's multiple owners and one of them passes away, their portion of ownership does go through probate. So again, that's why we don't ever see it, because you should use proper asset titling, which you use your trust to own things, and that way you avoid probate. Tenants by the entirety, that's another one. It's very similar to rights or survivorship. It's the passing of the last owner. Would it go through probate? But again, we really don't ever see that. That's proper trust planning. And for the most part, on a non-qualified account or a non-retirement account, what we're talking about, just put a TOD or a POD on it, and it solves all these problems of probate. So it's super easy. Okay. Asset titling for risk exposure. Now, here's what we're talking about when it comes to risk. What we're talking about is assets that are available to creditors should something happen to you. That's really what we're talking about, right?
Yeah.
So
Liability kind of
liability,
stuff.
yeah.
Somebody wants to sue you.
Exactly.
Yeah.
Exactly. So what are some of the conversations that we have when, well, let me say it. Is there a particular client that you guys identify when they come in that you would say, this is a conversation I want to have when they're putting money in an after-tax account or a non-retirement account? This is the type client that may want to consider doing some kind of risk evaluation before they put money just arbitrarily into an account.
Yeah, I mean, I had a meeting today, and I talked to you after the meeting about, they're affected through this stuff and all that. But in prior work, they had no idea about non-retirement accounts. Their accountant had basically said just pile money into all this deferred stuff, create a SEP, and everything was all like saving taxes, which again is fine. Most business owners are sensitive to taxes. They didn't understand that they could just leave assets in their business and invest it. Especially in our case, I think what we see most common is business owners have really closely held businesses or private businesses, and they have a lot of advantages with multiple ways that they can store assets, how they can use all kinds of different LLC structures and trust structures, because the other thing with these, you can also title them in the name of an entity, right? It could be a business, could be a trust, could be anything. And so there's a lot of advantages there, because you can pick, as an example, and we're going to talk about taxes, is you can pick when to pull. You can invest it as if it's your own in your business, right? Let it grow, because it's not a good year to take the money as a distribution, right? But it's not a good strategy to just keep a bunch of cash in your business forever for 30 years and then try to sell it. Right. So it's helpful then. You could take like bad tax environments, just invest the money in the business. And then when you get in a more favorable tax environment, or you have a lot of write-offs, you do some charitable giving planning in a year or whatever, that's a good time to move those assets out of the business into personal. So that's kind of, at least from my perspective, ways that we start having this conversation about non-retirement accounts and can be really beneficial.
Yeah, so let's stay on the topic of business owners, because I think you're right. I mean, there's lots of advantages. First of all, business owners, and we're all business owners, right? We're all individual business owners. They have so many avenues to protect assets and save money that sometimes it can be a little overwhelming. I know even in my case alone, just me and this is what I do every day. I've got to make sure that, I review every year and say, hey, make sure I'm funding the right accounts and they're titled properly and all that good stuff. But one of the advantages that and this actually was a result of the Tax reform that we had a couple of years ago was again, we're not tax advisors, okay? We're not, but we're not giving you tax advice. Don't misunderstand what I'm saying. But what I have found is some clients that are business owners, when they have assets that were managed in a non-retirement account, were able to deduct their advisory fee on those accounts, let's say up till a couple of years ago. And the only way they're able to do it now is if they put that same investment into an LLC, and they're able to deduct that expense. Now, again, I'm not a tax advisor. I have no idea if that's true. But if you're a business owner, I probably would look into it. Who knows? You may be able to do that. The other thing I'll say about owning assets inside of an LLC is that it offers some protection against personal liability, right? So if, for example, I've got a client who's a fairly wealthy person, and they're in a high risk, which we're going to talk about in a second, but they're in a high risk career. And so one of the strategies that we put in place was we put a non-retirement account that held a specific asset. We actually put that into an LLC, had his trust own that LLC. So if he were to ever get sued, now he's got plenty of insurance. But in the event he were, and his I don't know, if his judgment was more than his insurance could cover, and it came after his personal assets, then that particular asset would be off limits, right? Because it's in its own little world. And so that is another, again, risk strategy that we put in place is how to title assets. Maybe it makes sense for you to take money and put it inside of an LLC, maybe for tax reasons, maybe for risk reasons, but it's worth exploring, right?
Yeah, and that's a very valuable strategy for high income earners. And I don't know if you necessarily want to say what profession your client is in, but when you think about those types of professions that have to carry liability insurance on themselves just to cover any incidences that might happen just as a regular part of whatever they do for a living, this is a very valuable tool to be able to protect from a risk exposure, protect their assets, as you were saying. So, think about those types of industries, doctors, lawyers, truck drivers actually is another one.
Business owners
in general. Yep. Exactly. Yep. But in any of those types of professions, this could be a very valuable strategy to help mitigate the amount of risk that you carry just for yourself individually and by extension, your family, of course.
Yeah, sure.
So,
yeah, I mean, that's the thing is business owners have a lot of room for creativity, we'll call it.
Yeah, they do.
They can be pretty creative, but it needs a lot of coordination, and that's why if you look back at a couple, 2 or 3 episodes, we talked about the financial planning versus wealth planning. That's where it's not just a retirement plan. That's why wealth planning on a regular basis is important, is that you coordinate all this stuff, right? Like ultimately you have to have a coach that is coordinate all this stuff. And when something needs to be adapted, there's at least some structure there and understand which leverage and which knobs we need to turn to get it done right. So
yeah, but to your point, when I mentioned a minute ago that we had a client that we're talking about the tax deduction of the advisory fee in an LLC account. The only reason why we knew that is because and y'all know I do this, we sit down with clients at the end of every year with their tax preparer, because typically tax preparers are a little slower after, is it September, October is the 6-month extension for individual. So let's say October 15th until the beginning of the year, that's when they're typically slower. They're not slow, but they're typically slower. So we sit down at the end of every year, and we sit down with this particular client, and we walk through a bunch of scenarios, and this particular tax advisor said, hey, here's something you should consider. But we wouldn't have done that. We wouldn't have known that had we not sat down as a team and said, what is in the best interest of this client? And he said, you ought to consider this. We looked it up. We researched it. We're like, absolutely, they should do that. And so we set it up, and now they're able to take advantage of that little tax break. So, again, that is huge for us. I will tell you that if your advisor is not sitting down with your tax preparer and your attorney and you're not coordinating everything, you need to call us. Right here's our number, by the way. Or our phone number is 502-233-9800. We forget to do that sometimes because not everybody's looking at the screen. All right, so let's move on. Let's talk about taxation of non-retirement accounts. Eric, you mentioned this a little earlier in the show. We talked about 401ks, IRAs, 403bs. We talked about qualified accounts. That's what I was naming off there. Qualified accounts have special taxation treatment. You mentioned that money that sits in the account. It's tax deferred. It grows on a tax deferred basis, meaning you don't pay tax on it while it's there. And then in theory, when you get into retirement and you start to take distributions, is it taxed at that point? And it's typically
Treated as earned income.
treated as earned income. Exactly. Non-retirement accounts, a little bit different. So let's talk about the non-retirement. Give me some different ways that it is different than a qualified account.
Well, it's taxed on an annual basis based upon whatever gains occur in the account for that year. Now, this is where you're going to get into the weeds a little bit more, because then we're talking about, okay, well, what are the underlying assets that the account is holding? And so you talked about tax efficiency, and this is where we need to monitor those accounts a little bit more differently or a little bit more closely than we would a traditional qualified account. Because in a qualified account, it grows tax deferred. You can essentially do whatever you want to do in the account, and you're not going to realize any type of tax liability in that year. However, say for instance, if you own fixed income assets, bonds, bond funds, those are going to generate income, generally speaking, on a quarterly or semi-annual basis. Whenever income comes into that account, whenever you realize, dividends and things like that, that's going to be treated as earned income. That is different than if you were to own a fund for over a year within an account, and then go to sell that or move positions and realize a gain. That's when you're basically accepting a gain or realizing a gain in that account. The difference between what the cost basis was and what you sell that asset at, you're going to have a tax liability on that difference, and that tax liability is going to be based off of capital gains. It's a short-term capital gain if it's less than 1 year, which is equal to earned income, or if you held that asset for longer than 1 year, it's going to be treated as a long-term capital gain, which is far more favorable from a tax perspective than earned income and or short-term capital gains. So basically, you're looking at a 15, maybe a 20% income tax rate. Capital gains tax rate if you're a wealthy earner versus 24, 25, 32, whatever tax bracket you might be in at the time.
Okay, so just I want to. He packed a lot in there in about a minute and a half. So I want to make sure that's very clear, because
do a whole episode on that.
Yeah. So because taxation, I will tell you, taxation of accounts is huge. It's very overlooked in our business. I will tell you, because I couldn't tell you how many times we've had prospective clients come in. They go, "Well, I'm doing this." Well, why? Because it was a tax saving that year. Is that always the best answer? I will tell you, it's not. Yes, we have to consider the immediate impact, but we also have to consider impact 5, 10, 15, 20 years down the road. Perfect example before I get to this clarification. Ironically enough, this year we are giving more advice to clients to not put money in a 401k than we ever have because of tax reasons. If you want to know why, that's a teaser. If you want to know why, pick up the phone and call us. We'll explain to you why we encourage clients not to put money in a 401k. Not every client, but
the look of shock on clients' faces when you talk to them about that strategy and not maximizing 401k and IRA contributions is always priceless too.
Yep. So Isaac, just want to be. Let's just run through this real quick. So if I have a non-retirement account, okay, and I own a bond, and the bond is paying me interest, that is taxed as
income tax.
Ordinary income.
Yeah.
Right? Okay. Capital gains is taxed as what?
Taxed as it's long-term cap gain. So
so it's either short-term or long-term capital gain.
So a short-term gain is, to his point, income tax, ordinary income tax, whatever your income tax rate, versus a long-term gain, which is a year or more, which is 15% for most people, unless you're one of those people and you know who you are, that you ring every little bell in the tax code that is in the situation except. So high-income earners have a higher thing, but it's still way more favorable than income tax rate.
Right. So capital gains is treated, in some cases, treated differently than if you're receiving bond interest, right?
Correct. Yeah.
Okay. Just want to be clear.
Yeah, and that's why, to Eric's point, you have to manage those accounts differently. Yep. So, we build our own models and manage those, and you have to take a long-term strategic approach to that, because you don't want, to Eric's point, if you do a lot of internal trading on there, you can generate short-term gains if you're not paying attention. So
So the other that I want to just be very clear on is when you receive dividends are treated differently, right? Because that's dividend income. So just make sure that You have, because there's multiple parts of that. And the reason I bring all that up is to make this single statement is when we talk about tax efficiency, the non-retirement account every year is incredibly tax inefficient, right? Because you're paying all these taxes as you go. However, when you get years and years and years down the road and you're now in retirement, it kind of flip-flops, right? Now that account can be very tax efficient, and your 401k can be, this year, while you're putting money into it, is tax efficient, right? Obviously, because you're not paying tax on it. But it almost kind of flip-flops when you get into retirement. Then it becomes very tax inefficient because now you're having to pay income tax on it, whereas you can actually set a non-qualified account or non-retirement account to be very tax efficient. I mean, they can be super tax efficient, but it's not that way while you're in your earnings.
Again, this done appropriately is magical. Like you can,
For sure.
You can do some really advantageous things. Done inappropriately, I'll give an example. So we had a couple clients we were onboarding, and like I'm generalizing, but in general, I think the women are more gracious about the strategies they take. Sometimes the men can be a little braggadocious about their brokerage management. But this gentleman had a what he called his playpen. It was about $250,000, and they had significant assets, so it was legit maybe to call it a playpen. But he was trading on margin, and he was day trading. And I don't need to tell you, but they made a little over $900,000 a year in income. So imagine what their income tax rate was. Mm-hmm. He's trading on margin. He's day trading short-term gains on margin. Mm-hmm. And then imagine maybe the market drop and having to fill a margin. So he liked to brag about how much he made because the account doesn't show the tax impact and all that stuff. Right? So when we looked at the tax returns, we're like, all right, cool. You got some cool return in here. You actually realize you lost money.
Right. Yeah.
But he was, let's go around, and he was talking about it. And we didn't hammer him on it, right? And he was a great guy, but it's just you don't realize, and if you don't look at the coordinated thing and how the actual net impact is for your family to build wealth, that's the goal, is to actually grow your wealth and, protect your family and have more financial freedom. Sometimes you can have a return, which even advisors are guilty of focusing too much on that.
Yep.
But at the end of the day, your job is to grow the net worth, make things more viable for families. So that was one example. It was just kind of like, you knew when you saw it, but then I was like, once you got, you're like, hey, how do we delicately not, drop the hammer?
That's a great way to think about it. How much is your net worth growing every year, not what's your rate of return? Because those two could be vastly different.
Yeah, because that account would never capture it, right? That account's just going to show that the money grew, but on the background, there was all this cash going into margin filling. Of course, it doesn't quantify that cash came outside to fill the margin. So it's just, it's important as families. And again, he was trying to do a really good thing, and he worked hard at it. So there's no knock there, and he was doing a good job trading. So it's just important, though. Sometimes, again, it's why wealth planning is super important.
Yeah, for sure.
I was also going to say, too, it's also super important to consider not only an asset allocation strategy, because what we see a lot of is we'll see clients come in the door and they'll show us all of their accounts, and maybe they have a non-retirement or just a typical brokerage account. But we're seeing it managed the exact same way as their qualified assets. And that's a mistake in most cases because, as I mentioned before, you need to treat those differently. So you might have actually completely different assets or holdings, dependent upon what type of account that you have. Now, the overall strategy, when we're designing, a risk tolerance for an overall portfolio, the overall strategy is going to make sense. But maybe when you're looking at one account versus another, one might have a tad bit more risk than another account, but the other one might be more tax efficient than another. So we want to make sure that we're matching tax efficiency with the right accounts from a management standpoint to make sure that we're managing for tax liability as well as return.
Yeah, sure. So occasionally, Isaac, this is kind of your baby, so I'm going to let you kind of run with it. So occasionally we run into clients that over the course of their life, they have accumulated a particular asset that may have low basis in it, right? Meaning they acquired stock at, let's say $5 a share, and now it's worth $50 a share, whatever the case is. And we often have conversation around, okay, we have this low basis asset in this account, And we have these different strategies around there. So why don't you talk about some of the things that you have conversation with clients around? And it may not, you can use another example if you don't want to use low basis, but
No, I think that's a good example.
yeah, okay.
Yeah, so in that example, like especially here in town, in Louisville, Kentucky, LUAVUL, for those that are listening from outside of Louisville, you have a lot of, they get stock that's, given to them through company as a perk or a benefit, right? To, encourage them to stay employed at these organizations and retain. And these companies do a great job of creating incentives to get long-term employment. And that's really important for those companies. So what'll happen if you work at a place 20, 30 years, and you retire as an executive there, you have stock that, you may only have spent $150,000 total cost basis on the ownership of that stock. It may be worth $1 million.
Right.
So, and that's the kind of what you're pointing to. So you may have, and we've seen bigger gaps than that on some of this stuff, right? Where some of the family members that started some of these businesses, it can be substantial. And so you have, in that situation, $850,000 in difference between cost basis and unrealized gain, to Eric's point. They don't realize that tax bill is not due until they sell that security.
Right.
So the way it works, and so what we do with those families is like, how do we title that? Do we put that in a joint account? Do we put it in an individual account? Well, one of the important things is when that security transfers from who owns it currently to someone different, that then they get what's called a step-up cost basis, which basically means it zeroes out the gain. Right now, the cost basis is not $150,000. Now it's $1 million, and then that person is only responsible for that moving forward. So in the big gap, that's you would want to make sure that you make that transfer happen. You don't want to extend that. So you want to keep that in the individual's name. And the other thing we'll do is when we're starting to build these accounts, if somebody comes to us and we're working on that, we'll look for any kind of significant age gap or health gap. Because what a lot of people do is the way these accounts work is when, if you have a joint account, for example, a husband and a wife, they've got $1 million in a joint account. When that passes on, right, transfers, and then the let's say the man passes away first, because statistically the husbands do, and then it goes to the spouse. Well, on a joint account, it eliminates half of the gain, right? The step-up cost basis moves to the middle, basically where it was. Right, so you eliminate half of it. If it was just in one person's name, it goes all the way up. So if there's an age gap where one spouse is much older, it may be beneficial for one of them to have the asset, because that, even if it's 20 years later, it may, if that person's significantly older, it eliminates the cost basis even while their spouse is still alive, maybe for another 10 or 15 years in some situations. Not that anybody's ever remarried someone much younger than themselves, but it has happened. We have met those people, all right? Or there may be a health gap. One of them has a known health issue that they've accumulated. They're in their 60s, and it's known. Now, we never know, right? But it's still like part of, again, a good wealth plan is we're not picking end of plan dates, but we do say statistically you should consider this as a family. It's a way to avoid some taxation that would be unnecessary. Is it 100% right? We will never know. If we knew end of plan for everybody, our jobs would be like really, it would be amazing how easy it would be to plan taxes and estates for people. But those are a couple examples. Big gains on company stock. Usually that comes from corporate stock.
Right.
Most people didn't buy Apple at the beginning and never sell it. People at some point will sell it, but corporate stock does tend to work that way.
Yeah.
Anything else you guys want to add to that?
No, it's great. No, I think it. Yeah, all those little things are what we find that most advisors never have. They don't look at it like we do. So I would just tell you, if you've got a situation like that and you got questions, give us a call. Call Isaac. Call me. Call Eric. You can call anybody on our team. Makes no difference who you talk to here. And if you can see the screen right here to get our phone number. If you're listening to us podcast, it's 502-233-9800. And if you're out of town, it's 1-888-218-3466. And by the way, the 3466 is Dino, and we'll do a whole podcast on what that means at some point. We're in the process of kind of rolling that out right now, which is going to be kind of cool. But anyway, we'll get to that. Maybe we'll have to do a full podcast on that when we launch it out.
Yeah. One last thing on the taxation. A lot of advisors, we talked about the different titles. So there's some people that maybe aren't wealth planners. They like to say that life insurance is the most efficient way to pass money on. And that it is tax free when it passes on. That's really cool. These basically pass on tax free to the beneficiaries too, right? And then they're just responsible for the tax moving forward. This is a great way to maintain wealth within a family, is to use non-retirement accounts to do so, because it gets zeroed out every time it passes on to someone different.
Yeah, but just make sure it's titled properly so it doesn't go through probate. That's the other side of this.
Brian likes the rules.
Yeah, that's right. That's right. So one other thing that that I like to use, or sorry, Goose. Does anybody know what movie that's from?
Top Gun.
Top Gun. That's right.
Yeah.
Sorry, Goose.
No, I am that old. Yes.
Yeah. Anyway, one of the things that we have conversation around when it comes to non-retirement accounts is it's a good it's a good account type one to save in, all that stuff we've been talking about, but you can also use it to distribute assets in retirement efficiently. Now, what do I mean by that? Here's one big mistake that we see when clients are working and they transition to their non-work life. One of the biggest mistakes they can make is changing income habits. Now, what I mean by that is if you are most people get paid twice a week, some people get paid twice a month, but just say it's twice a month, right? 1st and 15th. So typically what we often find, clients that obviously don't work with us because we would never do this, but clients that retire, and what they do is they go into this mode of, well, I'm going to transition and take Social Security benefits, and so I only get paid once a month. I will tell you, that's a huge transition when you're going from getting paid twice a month to getting paid once a month. Just from a budget standpoint,
yeah,
it's huge, and it's also emotionally taxing. Okay, there's studies that have shown this. So in the planning world, what we try to do is mimic best we can the same income pattern. So if you get paid twice a month, 1st and 15th, that's what we're going to set up. As an example, someone retires at 65, they take Social Security benefits, that typically comes in the 1st of the month. Then we're going to have another pool of money, typically a non-retirement account, where we're going to funnel other income in. Maybe it's distributions from an IRA, distributions from a Roth, whatever it is, it's going to pool into this non-retirement account where we can be somewhat efficient when we get into retirement, and then have that non-retirement account distribute money out on the 15th. So whatever comes in, it's $1,000 a month for Social Security that comes in, and you need another $1,000 a month for, that comes from all your other assets. Instead of you having to worry about pulling 200 from here and 300 from here, 300 from this account, pull all your income producing assets into a non-retirement account and have that non-retirement account distribute whatever you need every month on the 15th. I will tell you, that has been one of the biggest things that when clients retire, they go, you know what, that's pretty cool you do that, because now I feel like I'm still getting paid.
Yeah.
And emotionally, it's a whole heck of a lot less taxing. I'll be honest, when I first got in the business, we would see clients come in, they go, yeah, I took $30,000 out of my IRA, and they'd take it out, and then they would just watch it dwindle, right? This huge lump sum. They don't take anything else out, but they watch it dwindle, and it gets down to like $5,000, and they're hyperventilating now because they're saying, "Oh, I'm losing all this money," and it's like, why would you put yourself through that? When and then we introduce them to the way we do it, and they're like, "Hey, that makes total sense." Instead of taking out $30,000, I just take $1,000 a month, and it drops into my account automatically. It's just like I'm getting paid. So again, that's just another way we use that account. But again, you're going to want to make sure it's titled properly. That's another account. Make sure it's titled properly. Make sure you put your POD and TODs on it. And it's a great way to transition wealth to the next generation.
Yeah,
so.
And oh, by the way, you don't have to ask your advisor for money when you dwindle that account down too, right?
Yeah, that's right.
That's just like another thing where it's like we try to avoid that feeling. We want people to always feel like they have access and it's coming on a regular basis, because that's important. They then feel like they're in control of their income because that's important. I mean, that's one of those kind of strange interpersonal things, but it makes a difference.
It does, absolutely. So the one thing I want to end on, and I hate to end on a piece of negative news, but it's not really negative. This is more, you should think of this as more, hey, I just learned something today. So I'll chalk it up to that. But one of the mistakes we see, only reason why I brought
two
this up,
different angles completely.
because it's the only reason why I bring it up is because it's the last thing I thought.
This is going to be
before I
super
made it.
sad, but kind of great.
That's exactly right. But we see this a lot, and that is when you have a non-retirement account and you're wanting to avoid probate and you're wanting to transition an asset to your kids, we see naming kids on an account as part of an owner. That's a huge no-no. We don't need that. We don't want that. I'm not going to go into a ton of explanation, but a simple TOD, POD will work. And also a power of attorney will allow your kids to act on your behalf in the event you become incapacitated until death. And when you die, the POD and TOD will take care of it. So don't ever put your kids on your account as an owner. It makes zero sense. There's lots of ways to do it. So on a more happy note, you can you can add a POD or a TOD and add a POA. And by the way, if you get any questions, just make sure you give us a call. You got the phone numbers right here. For those listening, it's 502-233-9800. If you're out of our area, which nobody pays long distance anymore, I don't think, but what the heck. Our 800 number is 888-218-3466. So I'll finish with this on a more happy note. If you're driving around, you're mowing your yard or you're running or whatever, and you're listening to the three of us kind of gab about all this different stuff, and you subscribe so that you make sure you get our material every week, just know that if you want to come talk to us, we don't charge you to come and talk to us. You can come and pick our brains, spend an hour, get to know us, and say, hey, I've got this particular situation. How would you help us? And if you're working with an advisor and you go, hey, I just been listening to these guys for a while, and I want to find out what these guys are all about and how they're different than my current advisor, come see us and pick our brains. Say, how do you do this? How do you do that? What should I be talking about? What should I ask my current advisor? We're happy to spend an hour with you and address any questions you might have. And you never know, you might learn something, or you might find out, hey, these guys are actually pretty smart. I know they kind of goof around on these podcasts, but they're actually pretty smart. We've had a lot of clients that over the years that are clients now, but had an advisor, worked with an advisor, and they just came to see us and said, hey, you offered it, so I took advantage of it. And they wind up becoming clients.
One of the reasons we have the fee structure we do is, obviously the consultation is always free, but, we saw a path too, because a lot of firms require people to move assets, or there's no way for them to do work other than that. So, we can do an audit over everything you're currently doing in the plan and all that kind of stuff, and we can work out a way that makes sense economically in that to do that, to show capability and demonstrate, our abilities on that stuff too. So, we're flexible. We really care about families here in town. We want to make sure that everybody builds the wealth that they deserve for all the hard work that they put in, and really has a really good lasting legacy, not just with money, but with their values and all that kind of stuff. So
very good. All right, Eric, you want to sign us off, because I can remember all those
you should have
those social media things.
You should have these down pat by now.
Maybe or just maybe record Eric one time.
And then just hit,
Hey, if you're watching on YouTube, right there in that little corner, hit that red subscribe button. If you're listening on Apple Podcasts, if you could please subscribe, rate, and review, that would be greatly, greatly appreciated. And continue to listen to us. We appreciate it.
See you guys next week.
Everybody have a good one.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.